This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the government unleashes the unthinkable as more bank failures are imminent. And I want to understand that the recent failure of Republic First should not have happened. And even though they were a very small bank, they didn't go to the discount window. They didn't use any of the liquidity tools. They couldn't find buyers. And this has now caused the government to go into all-out panic as they realize this is the first of more banks that are likely to fail, which is why today they have unleashed the absolute unthinkable. It's all being done, as you're about to see, to save the banks, as we now even have new information that suggests the strong and robust labor market that the political elites are pinning the economy on is starting to fall apart. Now let's head over to Bloomberg, where he picked today's story up with that headline as U.S. holds quarterly debt sales steady. But that's not the big one. We mentioned this last week that buybacks could start, and they're now here as the government is in a position to buy back their old debt. The question asked is, why would they do this? There's one simple reason. It's because the places that are holding the most of this low-yielding debt right now are the banks, and they're hemorrhaging in a big way. They need to get this debt off of the bank's books without causing any alarms, because we know more banks are soon to fail. As officials said, they don't anticipate having to increase sales of regular notes and bonds for at least the next several quarters. Now, we mentioned this would happen as a move by the Treasury and former Fed Chair Janet Yellen, who now is, of course, the Treasury chief, to try to initiate a short squeeze on the bond market. She knows there are massive short positions sitting out there that are keeping yields elevated. If she can get the market to move in the other direction and bring all these shorts out of their position, that will bring yields down in a big way. Also then put pressure on the Federal Reserve in the coming months to face a cut, because as we know, they don't follow inflation or any of the other metrics they claim they do. All they care about is two-year Treasury yields, and Janet Yellen has a little bit of control over that, as pressure on the Treasury is expected to ease when the Fed slows its runoff of U.S. government holdings, something we anticipate coming very soon. The Treasury also announced a start date for its first debt buyback program in more than 2 decades. And you think about the timing of this. Why now? If the economy is indeed strong, why should the government need to go back and buy some of these old securities back? Well, again, it has everything due to the banks, as you're about to see. As Wednesday's Treasury statement also offered long-awaited details on the department's new buyback plan, these operations will be aimed at supporting market liquidity, which is interesting, and improving cash management. Now, officials have spent more than a year looking at this, and now all of a sudden think it's time to initiate the program. And there's a very simple reason they're looking at doing this, is because the banks are sitting on a lot of low-yielding debt. And granted, they're upside down on this in a big way, but the problem the banks are having is because the Federal Reserve raised rates so rapidly following the pandemic that the banks got stuck with this low-yielding debt at a time when depositors started looking elsewhere for higher yields and pulling money out of the banking system. Of course, then the challenge is that banks couldn't attract enough money back fast enough. They've had to borrow money from the Fed. They've had to do everything they could to get liquidity. The problem is they need depositors to bring their money back. Well, how do you do it? Well, you get the banks to raise what they're paying in interest, but if they can't because they have low-yielding securities, well, you simply buy them back for higher yielding ones. And now you're seeing the first operations intended to start this month on May 29th. That'll run through July. The Treasury plans to do weekly buybacks of up to $2 billion of nominal securities and up to $500 million for Treasury inflation-protected securities. The upcoming program bears little resemblance to the buybacks from more than 2 decades ago, because those were launched during a historic period of surpluses, which gave officials the luxury of retiring some outstanding higher interest securities. And that was a big move there because they had the budget to actually buy back and retire securities. Today, it has nothing to do with that, because you would never want to trade lower yielding for higher yielding securities unless you had an issue with your banking system and you needed a solution, because the Fed isn't in a position to cut rates just yet. And that is a challenge, of course, the administration is facing here. But one thing that shouldn't be a challenge is making money even when markets go down. As we can know, let's give you an update on our big trade we've been talking about. This came back from March, and even though the market has dropped here recently, look at this. This trade is still up in big numbers, and in fact, based on this information we're seeing from the Treasury, it's suggesting there could be a big move in the bond market coming. And for many of you that have 401ks and your big retirement IRAs that are holding a bond allocation, we're going to give you the edge as a subscriber on what to buy, how to trade that to make more money, and you can find out by just signing up simply below. There's a 30-day free trial. You get our CTA Time Pro, and again, you don't have to be a trader. Maybe you're just looking to accurately position your biggest asset. A couple times a year, we give you those tools. One is you can follow the machines, and we give you some very deep positioning here because the machines move a lot of money in a very quick fashion, but we run a historical overlay, give you the data every day, and a video on how to trade it. Maybe you like to trade the technicals, those things like the RSI and the MACD, no problem. We give you that plus a proprietary overlay to keep you in that trade longer, to keep it working for you. And we have some great setups here for both reports. And again, videos for both of them. And we have some real gems showing up on our reports. I can see it. And as soon as we get past this Fed window, I have a feeling we're going to see a lot of those trades take off. Don't want to miss out. And again, on the edge, we give you with managing your biggest asset. And here you can see the buyback operations. And notably, look at this. They're buying everything from 1 month to 2 year, 20 year to 30 year. They're going to buy back virtually everything. In fact, this is just telling the banks, if you have low yielding securities, come to our window, we'll buy them back, we'll sell it to you for higher yielding ones. Now, here's the key thing that's important to understand, because some of you are going to think, wait a minute, the government's going to pay full value for these? Not a chance. No, this is all about the yield. The government doesn't come in and buy things at par. That means the banks are going to still be upside down. But I want you to be thinking about the coming move here, because if you're trading a low yielding security for a higher yielding one, and the Fed starts to cut rates, well, as a bank, you make money on something called duration risk, and this puts the banks in a great position. Of course, Treasury Secretary Janet Yellen knows the Fed's going to cut at some point. If we get in a recession, they're going to cut a lot. This is what the banks desperately need, an attempt to keep them solvent without raising any alarms. But what I'm suggesting, my friends, is this is outright frightening, because it tells us the government knows that banks are in big trouble. And here you can see one of the reasons why is they're not able to originate new loans at higher interest rates. The Fed keeps telling us we need higher rates and we need them for longer, but yet the market has responded by saying, you know what? We're not going to borrow at these higher rates, and that means the lending book here, we see commercial industrial loans in contraction, running around a minus 1.0% year-over-year rate of change, meaning, of course, banks on net are here destroying money. They're not generating enough new loans to back deposits. So now they're having to rely on these Treasury securities at low interest rates. That's why Janet Yellen here is jumping to their rescue ahead of the Fed, and now setting up the banks to be in a great situation as they'll offload as many of these securities as they can and max out these buyback programs. You'll watch and see, because when the Fed eventually cuts, the banks are going to need to sell these to raise cash, and this is going to give them a little extra boost that they wouldn't have before. Because one of the challenges we know is the economy is indeed heading into a recession, and we've got a bunch of reports on this today. Because keep in mind, we continue to hear from the Federal Reserve, the political administrations, that what is keeping the U.S. economy afloat is a strong and robust labor market. We've been suggesting it's going to eventually fall apart, but the ADP says not quite yet, but well, that's just only the headline data. Let's take a look at what's going on in the labor market, because U.S. companies now added 192,000 jobs, but here's the key part. Wage growth cools in the ADP data. So what this is suggesting is even though we're creating jobs, it's not having an effect on the economy. We look at what's what's going on, of course, with commercial industrial lending. It's slowing down. GDP growth slowing down. We see all kinds of metrics telling us the economy is slowing, and we've got some more today to validate that. But the key part here is wage growth is falling, meaning consumers are going to have less ability to keep up with inflation, means they're going to cut their spending any more and more. As back-to-back gain was the largest since the middle of last year, as job gains were strongest in the South. And hiring was broad-based in April, led by leisure and hospitality as well as construction. The information technology sector was the only sector that shed jobs. Of course, we know a lot of these tech companies, they claim they overhired following the pandemic and they're cutting jobs. Of course, those people aren't going to be looking for jobs in the leisure and hospitality space at all to replace their incomes. But the bigger issue now is the labor market has remained more resilient than economists have anticipated over the last few months, even if it generates low-wage jobs. But despite elevated interest rates, there's been a consistently healthy demand for workers. Now, this is where I'm struggling with, because they're telling us that the labor market is strong, but wage growth is slowing down. And that means, according to them, that of course there's a healthy demand for workers. But if you look at a supply and demand scenario, if there was a healthy demand for workers, then wages would be rising, not falling. So don't be fooled by these headline numbers. A lot of this could be, again, leisure and hospitality leading into the summer months, and those are typically very low wage jobs compared to especially those tech jobs. And as it notes, a low level of employment, which has helped fuel consumer spending and keep prices elevated. But what have we seen? Consumer spending slow down. So a lot of these articles don't make sense. You see economists, they focus on the labor market. They think just because a job is created, the next thing you know, the economy is booming. What matters is the type of job and how much it pays. Big difference between, say, $20 an hour and someone making a couple $100,000 a year. There's a huge gap on that. And that's the difference between, of course, some of those tech jobs and some of these summer jobs, as wage growth has cooled in the ADP data. And for those who've changed jobs, wages still rose by 9.3%, but down nearly a percentage point from the prior month. Workers who stayed in their job only saw a 5% median pay bump, similar to March's. And that is, of course, one of the problems here, because what we know is the labor market is not strong. And the evidence of this is simply in the labor force participation rate. And you can see that in blue. And this is the percentage of people that are participating in the labor market. And you notice it's going up here. And you typically don't see it rise when the economy is booming. But what's happened as a result of that, average hourly earnings of production and non-supervisory employees, shown in red, has been declining. So what it's telling us is there's more and more people entering the labor force. They can't find a job, and that's putting downward pressure on wages. Now, that doesn't exactly sound like a booming and strong labor market at all. What it sounds like is employers are getting the ability to cut wages here because they have too many applicants for the jobs they have. And sure enough, we can see that there's also a strong relationship between average hourly earnings and unemployment claims, as we now take a look at continued claims. And we can see as continued claims rise, shown in blue, average hourly earnings decelerate. Again, it all tells us what's very clear about the economy is as more and more people are on the unemployment line and more people enter the labor market, that employers do not need to pay competitive wages. They can actually cut back on average hourly earning growth, and they do that every time here. So we're likely to expect on Friday, when we get the non-farm payroll report, to see, of course, the official headline government data indicate that average hourly earnings are declining. This means that just after months of starting to get ahead of inflation, after years of being behind it, the average American household is about to get pinched again, and it means they're going to cut spending in a bigger way. And as a reminder, this from Zero Hedge, they note that the ADP headline data has underestimated the BLS magical print for 8 straight months. So look for a blockbuster BLS report coming on Friday, but don't expect the hours worked or average hourly earnings to be blockbuster at all, because one thing we've now noted, that while the ADP says everybody's hiring, the problem is fewer companies are actually looking for employees. Today we got the job openings and labor turnover survey, and it hit a 3-year low, showing a cooling labor market is at hand. And this is a huge red flag, as available positions decreased to 8.49 million from an upwardly revised 8.81 million reading in the prior month. This according to the BLS. The figure was lower than all but one estimate in a survey of economists. Now you think about what the Fed's trying to do here is they're trying to curtail demand, and their goal is to say, let's have fewer job openings. But if you have a supply and demand mismatch, as we do, the best thing to do would be increase supply. You need more jobs, more workers. Instead, the Fed says, no, we want to have fewer jobs, put more people on unemployment. And people say that, why does the Fed engineer a recession every time? Because they crush demand. Instead of increasing supply, they reduce demand until the economy falls into recession. And here you can see it in the JOLTS survey. And this report illustrates the kind of cooling in the labor market that the Federal Reserve would like to see. Again, they want to see fewer job openings, and that means demand for workers slowing. And that doesn't make any sense. They think that if employers just cut back on their job openings, that everything will be okay. The issue here is consumers aren't keeping up with inflation to begin with. So now some of them are forced to go back to work. And what are they finding? There just aren't as many job openings. And this is, again, a challenge because it all leads to a reduction in spending. So you think, and you look at the JOLTS report, and you look at the continued claims data, and you say, look, this doesn't make any sense. We have more and more people on unemployment, and we have fewer job openings. This is all the hallmark of an economy that's spiraling down and about to break, and starts to make perfect sense why, after a year of waiting, that Janet Yellen and her Treasury team finally decide, well, we need to engineer a buyback program because the banks here are in big, big danger. And we can look at job openings against average hourly earnings of production of non-supervisory employees, and lo and behold, we find a beautiful relationship that says as employers cut job openings, well, that also means wage growth continues to slow because they don't have the demand that they need to drive wages higher, and that means the existing employees can't command higher wages because there's a fewer lower need for employees. We see that relationship happening now, suggesting that as average hourly earnings go down, which again we'll find the official data on Friday, suggests that, of course, the JOLTS data is going to head lower. And that's going to be a big problem for the equity market, as I'll show you in a minute, as the so-called quits rate, which measures people who voluntarily leave their job, fell 2.1%, the lowest since August 2020. So you think about this. Why do people quit their job? Because they feel either they're retiring, or they have an opportunity to go elsewhere to make a higher wage. But when you start to realize that maybe there isn't great opportunity elsewhere, or you don't want to be the low man on the totem pole, you start to stay put. And this is an indication that employees are not confident about the labor market at all, as the decline in this metric recently suggests that people are holding on to their current roles. And there you have it, as they feel less confident in their ability not only to find a new job, because there's fewer of them, but a position that may pay better and may keep them there. And because we've certainly heard in the news people job switching, only to find themselves on the unemployment line a short time later. The hiring rate dropped to 3.5%, matching the lowest since the onset of the pandemic. The decline was broad, led by trade, and here's a key one, transportation sector. You want to talk about the evidence of a slowing economy, look at the transportation sector. You know, when things get shipped faster and more efficiently, and it's easier to get goods moved around, that's because there's less demand. So when the transportation sector goes, well, watch out. They note layoffs also eased, with the fewest people let go since the end of 2020 as employers hang on. But when we talk about hanging on, we look at the equity market, as everyone is piled in this to the long side. But you'll notice a relation between JOLTS and the Wilshire 5000, the Wilshire 5000 being the total U.S. stock market. Here you can see that even though the JOLTS survey went down, and we noted this as, of course, everyone was piling in the market saying we're at the cusp of the next big expansion, the next big bull market, the labor market is saying, nah, not so quick, creating kind of a jawbone here. The question is, which one will collapse? Will job openings rise, or will stocks eventually come down? Well, as we turn to S&P Global to get a pulse of the manufacturing space, it suggests that perhaps the equity market's on the wrong side, as new orders are now down for the first time in 4 months. This is not a good sign, of course, for the U.S. economy, as manufacturing new orders decreased for the first time in 4 months during April, while modestly. Response signaled caution among clients and a reluctance to commit to new business amid subdued market conditions. The reduction in total new business was recorded in spite of sustained growth in new export orders. New business from abroad increased for the third month running, but only ever so slightly. And of course, the bigger problem is work on backlogged orders. A further depletion of outstanding business was the latest solid decline, the most pronounced since January. So what you're seeing here from the labor market perspective in the manufacturing space, if you run out of backlogs, which it appears that at some point we're going to get there soon, and you don't have enough new orders to sustain your workforce, well, you're going to start cutting their hours, and that means, of course, that less money into the economy. But the next big thing that happens is you start sending people onto the unemployment line because you just don't need them. And here you can see the evidence that average hourly earnings growth is just suggesting that's what's happening here. The demand is getting weaker. Employers have no reason to give out big raises. One, they're not getting the business. Number two, they have plenty of workers. And you can see here manufacturers' new orders in blue decelerating against average hourly earnings of production and non-supervisory employees, that following with a lag. You see that relationship here virtually every time, and now we're seeing the same thing. Demand for new orders going down, average hourly earnings following. And of course, as we're going to find out Friday, things here are about to get far worse for the labor market. We might get a red hot non-farm payroll print. Don't put that beside. That could happen. It's always about the details underneath that matters, because at some point the U.S. labor market's going to go and fall apart in a big way, and that won't happen just until, I think, the banks, they're going to be the first ones that go, but not on Janet Yellen's watch. She's going to do everything she can to keep the banks from failing. We'll see if she's successful. My guess is she won't be. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.